Welcome to Economic Outlook During Unprecedented Certainty, presented by the FEI Twin Cities chapter. Thank you for joining us today. Before we get started, we'd like to share some information regarding CPE credits with you, and we appreciate your patience. Today's webinar is worth 1 continuing professional education credit. To be eligible for CPE credit, you must answer at least 3 of the 4 polling questions during the webinar and have a total viewing time of at least 50 minutes. Participants will have the opportunity to download their CPE certificate immediately following the webinar if the above requirements are met. In accordance with the standards for the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. We are unable to grant CPE credit in cases where technical difficulties disqualify eligibility. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements listed above. I encourage you to download today's presentation, which is located in the resources widget on the lower right-hand side of your screen. After the presentation, this webinar will be available on the FEI member site where you can replay and download. After the conclusion of the webinar, your CPE certificate will be available in the certification widget and will also be emailed within 24 hours should you meet the criteria. Below the speaker biography widget is the Q&A box. Please feel free to ask questions throughout the presentation, and the speakers will answer as many questions as possible. We're now going to get started with our first polling question. What impact has COVID-19 had on your business? Positive, negative, or none? Please be sure to make your selections and press submit once you have made your selection. I'll give you about 10 more seconds left to respond, and we'll move forward towards the results. And here are our results. It's now FEI's pleasure to introduce Kate Kelly. Kate?
Thank you, Michelle. Again, I'm Kate Kelly, Regional President for PNC Bank in Minnesota. We are delighted to be with FEI Twin Cities today, and all of you. We are in for an informative and interesting discussion. Before I introduce our speakers, let me update you a little bit on what PNC Bank is doing in Minnesota. As many of you know, PNC has worked with companies in this market for many years. In 2017, we established a local office, and that is when I joined PNC as a regional president for Minnesota, and we began to build a local presence with what we call the RP model, or really a Main Street Bank model. We are one of PNC's first expansion markets back in 2017. This organic growth plan has exceeded our expectations. Since 2017, PNC has established 10 expansion markets. We plan to continue at a very good pace into other very desirable markets. We have an amazing team here locally with corporate banking leaders with Peter Kellenberger and Kelly McQueen in our specialty areas such as healthcare, public finance, financial institutions, real estate, and many others. We are continuing to build locally. You will see us build out solution centers, or basically very unique, modern, and going forward branches in the next couple of years, and we'll have a greater presence in the commercial and wealth segments. In addition to growing our business and presence with our clients, we have been hard at work and very intentional in the community as a Main Street Bank. Along with many of our community partners, we are focused in areas where we believe we can make a positive difference. We'd like to call those areas our philanthropic pillars. These pillars are in the areas of early ed. We have a program across PNC called Grow Up Great, where we've committed $500 million over the last 15 years. Here locally, we really have made a specific focus on early math, and we've just committed over $1 million in that area to help kids really get a great start in life and in education. And our second pillar is arts as a vehicle for economic development, and the third is women in leadership. On this important day, Juneteenth, I would be remiss if I did not share an announcement that PNC just made yesterday. PNC announced a commitment of over $1 billion to help end systemic racism and support economic empowerment of African Americans and low to moderate income communities. I know all of you and your companies and all your employees have also had this at top of mind today and going forward. We look forward to really getting at some long-term solutions and truly changing the fabric of our community and making us a stronger country. So what a great opportunity to mention that today and this morning. It is now my pleasure to introduce our wonderful colleagues who you will enjoy hearing from this morning. Please be ready with your questions for our Q&A following their remarks. First of all, Stu Hoffman. Stuart is our Senior Economic Advisor for PNC Financial Services Group. In his role, Stu works with PNC clients to provide expert analysis and forecasts for national, regional, and global economic and financial trends. Prior to being named to this role in April of 2017, he served as our PNC Chief Economist and was principal spokesperson on all economic issues. He was recognized as the most accurate economic and interest rate forecaster in the prestigious Wall Street Journal Economic Survey. Stu joined PNC in 1980 after a 6-year tenure with the Federal Reserve Bank of Atlanta. He has frequently been quoted in Wall Street Journal, New York Times, Financial Times, and Barron's, and he was a regular guest on CNN, CNBC, and Bloomberg TV. In addition, he was regularly interviewed by Associated Press, Reuters News Wire Services, and NPR. Stuart was past president and lifetime member of the American Banker Economic Advisory Committee, which meets regularly with the Federal Reserve Board of Governors, chaired by Jay Powell. He is a graduate of Pennsylvania State University. He received his master's and a doctorate in economics in 1975, both from the University of Cincinnati, where he was the Charles Phelps Taft Memorial Fellow. So we are in for a great delight with Stuart. And also I'd like to introduce now the subsequent speaker, Mark Mcclellan. Mark is our Chief Investment Officer of PNC Asset Management Group, including PNC Wealth Management, Hawthorne, PNC Financial Wealth, and Institutional Asset Management. In his role, he is responsible for the firm's overall investment strategy, portfolio and risk management, and investment solutions. In addition, he is responsible for the development and execution of investment policies for the Asset Management Group and serves as chairman of the PNC Investment Policy Committee. Prior to being named to his current position in 2018, Mark served as Chief Investment Officer and President of PNC Capital Advisors, a registered investment advisory subsidiary. Mark earned his bachelor's in art degree from political economy from Johns Hopkins University and a master's of science degree in finance from Loyola University, Maryland. Again, Mark is just a wonderful colleague. You're in for a treat. And with that, I'm going to turn it over to Stuart Hoffman.
All right. Good morning, Kate. Everyone hearing me well? Sorry I'm not with you in video. Kate has told you a lot about PNC and her role. She's a true leader for us in the Minneapolis, Minnesota region. So it's a real pleasure to be with her and my friend and colleague, Mark McGlone. We do a lot of presentations together. So hopefully today we'll come together. I'll talk more about the economic outlook. These days, we're not doing a lot of charts because everything seems to change so quickly, but I do want to run you through our view on the economy, where we've come through, where we think we're headed. I can tell you I speak to a lot of FEI groups. I commend you. You're a very strong, a very active group. I've spoken to many in the Midwest, here in Pittsburgh, where I'm based, so I know that you're a very active organization, and I welcome the opportunity, along with my colleagues, to be able to talk to you today and then take your questions. So officially, the National Bureau of Economic Research said a couple weeks ago, to no one's surprise, that the U.S. economy is in a recession. Sometimes it'll take them longer, but obviously the effects of the global pandemic, not only in the U.S., but the global economy has made it obvious the economy has declined. But we're thinking this will probably be the deepest, but perhaps the shortest economic decline or recession that we've seen. We talk about the economy, going down, straight down in an elevator, maybe coming back up on an escalator. So it'll take a while to recapture where we were, but we do think the worst of the decline in economic activity, the worst of the rise in unemployment, although not necessarily in bankruptcies and credit problems, but from an economic point of view, We are encouraged that, of course, March and April were terrible months for the economy, but the data we've gotten on May, the surprise increase in jobs, the huge rebound in retail spending, some improvement in industrial production and housing as the economy has opened up. We expect to see this continue and have very recent data suggesting it has continued into June. And we talk about this sort of U-shaped economic recovery. In terms of growth rates, when you fell as much as you did in March and April, and you annualize these, that's why it looks awfully big to say retail sales were up 17% in April, but, they fell even more in March and 17% in May. They fell even more in March and April. I've started to look at where we are, compared to a year ago, or even compared to February, which was the peak. Our view is in the second half of this year, GDP growth, economic activity, housing in particular, very strong housing numbers in response to these record low mortgage rates will show the economy continuing to grow. Of course, the virus and whether there is, I don't know if they call it a second wave or not, because maybe we're not even over the first wave, it's clearly going to impact the pace of growth and whether or not we have to go back to sheltering in place or slow down the rate of opening. That I can't possibly predict. But what I do think is that the Federal Reserve, through its so many different actions, initially lowering interest rates to zero back on March 15th, doing quantitative easing, buying Treasury securities, but then doing so much more in the corporate market, in the money market, in the credit markets. It now has a Main Street lending program up and running. The Federal Reserve has been heroic. Exactly the opposite, frankly, it did in the early 1930s, although clearly a lot has been learned by economic science since then. So this time the Fed increased support, unlike what they did in the 30s. And I think that has been a lifesaver for the economy, an economic lifesaver. It's prevented, this terrible global health pandemic, prevented it from becoming a financial crisis on top of that. In addition, the government, the federal government, with the CARES Act, and what I suspect will be another installment of that passed by the end of July, early August, at least another $1 trillion. The Democrats have a $3 trillion bill. McClellan and the Republicans have been talking about something less than that, but what the CARES Act did that we've gone through, they provided the one-time checks, $300 billion, which have pretty much now all been received. Much of that was received in April and May. Unemployment insurance, in addition to the regular unemployment insurance that people are entitled to, the extra $600 a week, $15 an hour, goes through the end of July. My guess is that will be maybe not as big the next time, but there will be some re-upping, shall we say, of a supplement to the regular state unemployment insurance in what I think will be the next CARES Act, which will add more fiscal stimulus going forward into the second half of the year. So between the fiscal stimulus and why were we able to do it? Well, the Treasury is going to borrow over $3 trillion, and it'll probably be $4 trillion. Yet it's doing it at record low Treasury interest rates. Part of that, of course, is that the Fed is buying a lot of those securities, but the whole world is lined up to buy U.S. Treasury securities. The rates are positive, unlike in Japan and Germany and Switzerland, where you actually get negative interest rates on government debt. And the dollar has been fairly strong, come off a little recently. So we're in an enviable position, at least in the short run, where we can run massive budget deficits, fund them at record low interest rates to build a bridge. Mark might talk about that later, building a bridge between the tremendous economic disruption that occurred in March and April, and as we begin to open up, hopefully safely and slowly, build a bridge to get us through there. And as I kid, I don't think this is one of those wood and rope bridges that you see in every Indiana Jones movie. I think this is a lot more solid bridge that will carry us across, and is carrying us across, obviously, the devastating decline in the economy and rise in unemployment that we saw in March, April, and into the beginning of May. So we look, as I say, to sum it up, we look for economic growth to be back on the positive side. Not this quarter, because the decline in April was so devastating that even some recovery in May and June means this economic GDP will probably be down 30 to 35% in the second quarter after having fallen 5%. As I say, the deepest drop in the GDP we've seen. The unemployment rate rose in April to over 14, almost 15%, and frankly, that was understated. It fell in May to 13.7, but even that's understated. The BLS itself says it's probably closer to 18%. But we think it's probably peaked there. Some of the forecasts, not by us, that we might get a 25 or 30% unemployment rate, fortunately, proved to be much too dire. So we think over the second half of the year, we will see increases in jobs. We think the unemployment rate can come down to a still high level, something around 9 or 10% in the fourth quarter by the end of the year. That would still be extraordinarily high, the highest it got in the great financial crisis in 2008-9 was 10%, and in the really deep sort of double-dip recession in the early 80s, the unemployment rate got to 10.8%. So we've unfortunately exceeded them, and even getting the number down into the high single digits is extremely high. We really don't think the U.S. economy can regain the economic ground and the job ground until probably into 2022. But we think we can get there. So our view is that, to sum it up, the economy, crashed down. It is starting to rebuild. It is still obviously subject to the health crisis, and clearly there's been outbreaks in many states. Fatalities continues to rise, not as fast of a rate. The number of people confirmed with COVID-19, in part because of more testing, but I think probably also in part because we've done a lot less social distancing since Memorial Day for a variety of reasons. But as I said, I think we're going to see some better data next Friday. 2 weeks from today, we'll get a report on the June job number. We think that will show a drop in the unemployment rate, and we think that that is the leading edge of this economic recovery. But the amount of economic destruction and devastation and some of the longer-lasting impacts on many industries where people, sports, entertainment, travel, where you have a close proximity, even in our workspace. I've been working at home, as I'm sure many of you have, for the last 3 months. PNC intends to bring people back to work, but, I think the way we work in the future, in terms of coming into the office, will be different. So there will be lasting implications of this. Certainly it has sped up the amount of buying we do online to the advantage of a lot of very large retailers that Mark might have something to say about. But I'll just sum it up by saying, somewhat on a positive note, we think the worst of this virus recession in the U.S. and globally is behind us. We think we have begun a recovery. It is, of course, always subject to the course of the virus. Who knows what the election, almost a little early to talk about what the impact the election could have on the economy. We'll be following that much more closely as we get closer to November. We do think that we're on the road back to recovery. But as I say, it's more like climbing steps or going up an escalator after a pretty sheer straight down drop that we experienced from mid-March, at least until early May. So I'm going to stop there. I know my friend and colleague Mark can talk to you a bit more about the market implications that we have been focused on and helping our clients manage through this challenging but opportunistic time. Thank you.
We now have another polling question here. What is your outlook for the global economy? positive, negative, or none. I'm going to give you about 10 more seconds left to respond. Please be sure to make your selections and press the submit button for your answer to be recorded. And here are our results. We have one more polling question before getting on to Mark's part of the presentation. What has happened with your company's working capital in the past quarter? Increased, decreased, or stayed the same? Please be sure to make your selections now and press submit once you have finished. I'll give you about 15 more seconds left to respond, and we'll go to the results. And here are our results.
I might just jump into that. I was glad to see more people answer. They were positive about the outlook for the global economy than negative. So that was encouraging to me, and obviously that was the answer that I gave as well.
Mark, take it away.
Okay, thanks so much, Michelle, and thanks Stu and Kate for your initial remarks. It's great to be here with the Twin Cities FEI chapter, and hopefully I'll be able to take the comments from Stu and weave them in with our outlook on the markets. As Stu described, the economy is recovering from definitely the quickest and sharpest recession we've seen ever. The Great Depression obviously had dramatic downturns during it, but that lasted over several years. This particular correction, economic correction, as Stu indicated, might have only lasted 1 month. Looking back at the beginning of the year, as the equity market began to focus on the pandemic, sort of late in February, we had a series of dramatic declines in equity prices that brought about the quickest and sharpest equity market correction over that month that we've ever witnessed. The S&P fell about 34% between the highs in mid-February and the low on March 23rd. Importantly, at that time that the equity market was tumbling, the bond market and the money market were also under stress, and a lot of times the fixed income markets are flying a little bit below the radar simply because the equity market seems much more exciting at times. But in the bond market, credit spreads on investment grade bonds were starting to widen, essentially doubling in a few short weeks, while the yield spread on below investment grade or junk bonds tripled over that same time period. Additionally, prime money market funds, those funds that invest in commercial paper as well as government T-bills and the like, started to see large outflows, and several large fund sponsors had to step in and support those smaller prime money market funds keep their NAVs stable. Money market rates were at that time well in excess of the Federal Reserve's target on the Fed funds. Additionally, the municipal bond market was no safe haven during that turbulence. At one point, variable rate demand notes, one of the key investments in the municipal money market system, were yielding about 8% when the Fed funds target, as I was saying, was between 0 and 25 basis points. The Barclays Municipal Bond Index had a total return on a year-to-date basis during that turbulent time period of about a negative 7.5%, while the long Treasury Index had a total return of a positive 15% over the same period. This was a difference of almost 22 percentage points in what should be a very positively correlated asset. How did this meltdown sort of occur so rapidly? And I realize I'm going back in history here. This is March, so we're way beyond this, but I just wanted to sort of set this up. First, and individuals look to sort of husband cash in the midst of the unknowns of the pandemic. corporations tapped their revolvers, their credit revolvers within the banking system, thus quickly starting to grow bank balance sheets. Money market investors, especially in prime funds, became nervous seeing so many companies tap their credit revolvers rather than funding in the commercial paper market. So investors, both institutional as well as individual, started to move money from prime money market funds to government money market funds. Additionally, investors sought to sell whatever they perceived to be liquid. And in Wall Street and mainstream banks were somewhat constrained on how much they could expand their balance sheets due to the simultaneous revolver draws and the demands for liquidity. So in essence, liquidity began to dry up and prices started moving to fire sale and market clearing levels. And then as Stu indicated a little bit earlier, the Federal Reserve recognized the issues rapidly and came with the fire truck, the hook and ladder, all kinds of emergency vehicles to help quench that issue. And they began with a series of actions to restore liquidity and reduce the stress on the financial system with programs of all different kinds of acronyms, CPFF, PDCF, MMLF, PMCCF, and the well-known SMCCF, or the Secondary Market Corporate Credit Facility. And this is the one that happens to be in the news recently due to some purchases. Each was designed to target specific pain points within the system's financial gears. And since all of those announcements back in March and April, and some have continued clarification since then, the financing mechanisms have improved markedly. Corporate bond issuance has been on a tear as multiple companies repay their revolver lines that were drawn, as well as taking advantage of extremely low interest rates to build up reserves. The mere fact that the Fed announced all of these programs reintroduced some stability into the market and established a floor. Since then, credit spreads have fallen 200 basis points on investment-grade credits and about 500 basis points on high-yield corporates. The equity market, seeing the stability and the improvement in the fixed income markets, has definitely been on a tear since the lows of March 23rd. Since that time, the S&P is up nearly 40% since the March bottom, and some of the largest constituents within the index are up 50 to 60%. Indeed, some of the well-known stocks are at all-time highs or very near to their all-time highs. So net, on a calendar year-to-date basis, as of yesterday, the S&P was down only 2.7%. And we sit there and say, how can that be that the market's only down a little bit, 2% or so, almost 3%, when the U.S. is going through currently in second quarter, probably the sharpest and most severe contraction over a small compacted time ever seen. And as Stu indicated earlier, much of this has to do with all of the actions of the Federal Reserve, as well as all the actions of Congress and the administration put stimulus back into the economy. So if we turn to the next chart, the next slide, I have a chart that's called the good, the bad, and the ugly. And this is a slide that we use on an ongoing basis, much like a theater. And think of it from the standpoint that in any theater, you have actors that are on the main stage, and you have actors off on stage left and other actors off on stage right. And so the market is continuously focused on certain actors who happen to be in the center of the stage. But as the scene changes and the play evolves, other actors come onto the stage, and the ones that were previously in center stage are now off stage. So this slide entitled The Good, the Bad, and the Ugly, which is somewhat our homage to Clint Eastwood spaghetti westerns back in the 1970s, shows the different characteristics or ideas in the market that may be center stage and how they're characterized at any one point. So things on the left, the good, those are items in the marketplace that are perceived to be a positive influence on the market. The bad, which seems to have a long list on it today, focuses on those things that are probably holding the market back a little bit. And over on the right, the slide or the column that's labeled the ugly, these are issues that, were the market to focus on those in an undue amount, could really start to put the market back on its heels. And these issues, they move back and forth around the slide deck. So you can see on the far left where it has dollar weakness and a little arrow there, that means it's moved from one area, the bad, over to another area, the good, for a variety of reasons. So getting back to the idea about the S&P back to almost unchanged, other areas of the market doing quite well. You've certainly seen many of the equities in the tech sector doing very well over the past few months. Some in the consumer discretionary and some in consumer staples have also done well, whereas other areas within the marketplace have sold off somewhat, even in the face of the bounce. And so let's focus on a couple of those things. So let's look on the good for a minute. You can see unprecedented Federal Reserve actions. Stu's already talked about this. The bipartisan fiscal relief package. Also, Stu talked about this. And here we're talking about, just and again, I'm going to use the word unprecedented amount of fiscal stimulus on the part of the administration and Congress in order to support the income levels of individuals and companies to get through this, what is expected to be a relatively sharp but short contraction. And so that those relief packages probably totaled before any new one, roughly 15% of GDP. So a really strong package, a series of packages. And then we're seeing that also around the world. So we're seeing global policy accommodation in Europe, Japan, and then to some degree in China. The dollar weakness there had started, the dollar had been relatively strong even during the April-May time period. But as other countries have started their accommodative process, we're starting to see the dollar weaken somewhat. Also on the good side, we highlight some of the technology either innovations or old technologies that are being used more prevalently, just given the massive move from working in offices and working in shops and retail to working from home. And so all of the technology that supports that, when you think about it, has just been tremendous. And so companies that are benefiting from that surge in technology certainly are ones that are benefiting in the equity market. So think of private net VPNs, like virtual private networks, all the 5G technology that continues to be put into place, and then e-commerce, shifting, entire portions of the economy from interaction face-to-face to interaction virtually, whether it's from ordering groceries or other goods from Walmart or Target or Amazon, utilizing their e-commerce solutions, or from all the other smaller companies that are able to provide e-commerce solutions, but may not have the scale that those other companies have. That's sort of been the good side. And think of all those other companies such as this, where we're doing WebEx as opposed to in-person meetings. On the bad side, as we talked about, we basically had a global economic brownout. A brownout meaning certain sectors of the economy were flickering, were shutting down in total, particularly in small business. All of the smaller retails really have had difficulty during this time period. But other areas that could work from home, we're maintaining their business, maintaining their level of activity, the interaction between employees among themselves, the interaction of employees with customers or clients was continuing on. So, it's not all bad, but just definitely a push in terms of slower activity. The next one is the one I want to focus on, and this is downward earnings revisions. And when you think about the equity market is essentially trying to price forward earnings going out the next 5, 10, 15 years in order to value the essential enterprise value of a company. And beginning at the end of 2019, beginning of 2020, 2020 ended on earnings ended on S&P earnings of about $165 per share. And expectations for 2020 were somewhere around, high single digit, 8, 9, 10% type of earnings for 2020. Once the pandemic hit, once the economic contraction hit, those earnings have been revised down considerably. So what up 165 earnings back at the end of 2019, they're looking at down 20, 22, 23% type of earnings at this point before we get second quarter earnings reported. So we're going from 165 to about 128 in earnings. Looking into 2021, earnings on the S&P are expected to rebound back to the level that they were in 2019, so back to 164, 165. So round tripping over that 2-year time frame. The very interesting thing that's gone on in terms of valuations is at the end of 2019, forward or price earnings ratio on the S&P valuations statistics on the S&P looked at forward earnings and said we'll value those at 19 times forward earnings, which is high. The averages are somewhere around 15, 16% or 15, 16 times on a longer term average. Not undue, but not inexpensive. Fast forward 6 months to here we are in June. Obviously going through the part of the pandemic and then the issues of earnings revisions and the like, interest rates being cut as we discussed. Now we're looking at earnings that are significantly down, but the market is pricing those at a higher level, actually 2 multiple points. So we're now talking about forward price earnings multiples that are 21 times earnings. So the market is looking at all of the forward earnings and saying we're going to get past 2020, look at 2021, and is essentially discounting the bad news here over the next 6 to 9 months and looking at the economy recovering, earnings recovering, and hence valuation at that level. Our own thought process about this is market may be a little bit ahead of itself, not from the standpoint that it's on the precipice of any big pullback, but just it may churn here for a little while as opposed to the dramatic increase that we've had over the past 2.5 months. So the increase we've had since the beginning of April, as I was saying, probably close to about a 40% increase. We may be in a time period of choppiness for the next few months as second quarter earnings start to be reported in the middle of July and into early August. We'll get hopefully get better guidance from corporations in terms of their outlook and what their experience has been during that 2-year or 3-month time period. And then the market can then focus on further out. Obviously, we'll also have some turbulence that may be result from the politics. I'm not going to get into politics, but just to say there is an election here in November. And depending upon the various scenarios for how that plays out, market could start to focus on issues of regulatory increases or potentially tax increases and the like. One of the reasons why I say that is because, as we've spent, over $3 trillion, and as Stu indicated, we may spend another $750 to $1 trillion in the next stimulus package, which is being debated currently. Back at the beginning of 2019, the CBO, the Congressional Budget Office, was looking at looking at the deficit at roughly, we'll call it 4 to 5% at that time period. Now we're looking at deficits that are, 14, 15, maybe even more than that in terms of percentage of GDP. Back at the beginning of 2019, the CBO was forecasting that net federal debt relative to GDP wouldn't hit 100% until 2030. So, almost a decade out from now would be the time period when debt was going to hit about 100% of GDP, because federal debt was growing slightly faster than GDP. Now, with all the stimulus that has hit all at the same time period, all this deficit spending, and because GDP is going down, contracting in the most recent quarter, that debt to GDP ratio might actually hit 100 this quarter. Now it'll start to decline as the economy recovers and the massive amount of stimulus slows down, but it is still debt. It's still on the balance sheet, on the federal government's balance sheet. Now, as Stu also indicated earlier, much of that debt has essentially been bought up by the Federal Reserve. The Fed increased its balance sheet by about $3 trillion over the past few months. The Treasury has been issuing roughly $3 trillion worth of new securities over this past few months. So it hasn't really impacted the market. And as you can see, interest rates are very low. Fed funds are down at 0 to 25 basis points. The 2-year notes around 20 basis points. 10-year notes are down in the 60 to 70 basis point range. So all that debt hasn't impacted the interest rate scenario just yet, but at some point it may in the future. So while I was talking about issues in terms of debt to GDP, which we had thought was an issue that we could look a few years down the road, that may come to the fore in 2021, 2022, as opposed to 2020 or 2030. I'm sorry. And the last thing I wanted to mention in the midst of all of this just happens to be the relationship between the U.S. and China. And obviously, it's a very fraught relationship at the moment. There's an awful lot of tension between China and the United States. The fortunate or unfortunate situation, depending upon how you're looking at it, is the two economies are highly intertwined and have been getting closer for basically 20 some odd years, almost 30 years. Unwinding that relationship, either from a standpoint of supply chains, or from the standpoint of technology, or from the standpoint of working together to solve regional problems and the like, is accelerating. And it's accelerating whether it's a Republican administration or a Democratic administration come January of 2021. Unwinding that relationship in and of itself will have turbulence. As you've seen over the past few months, there's been a series of efforts in order to reduce technological exchange between the United States and China. Companies that have any relationship to the Chinese military have been, U.S. exporters are prohibited from sending certain material to those companies because they might be shared with the Chinese military and the like. That relationship, no matter how we slice it, how we reshore or onshore and the like, that relationship is going to be the primary relationship that has to be managed by the United States over the next few years in order to avoid greater turbulence. It's going to be tough just given everything that's gone on over the past 3 months, but it is something that we as investors have to focus on because it is such a dramatic relationship and possibility of changes in that relationship. So why don't we stop there? We've got interest rates really low. Looks like it'll be low for a long time because of the Federal Reserve. The equity market looking fully priced here at these levels. That's not to say it can't go higher in terms of price earnings ratios, but previous times when we've been up at this level, it's been time periods of turbulence. Sectors within the market that have been doing well, obviously technology has been doing well. Consumer discretionary has been doing a little bit better with the bounce in the economy. Some other areas are still having turbulence, whether it's on the financial side, and the banks are pretty much mired where they are right now with interest rates so low. And then areas such as REITs, which obviously are always attractive from an income standpoint, are also facing some turbulence because of the underlying real estate markets. So why don't I end there? And Kate, if I can turn it back over to you for any questions that may have arisen during the discussions.
Hi, Mark. We're just going to do one more polling question before we head to Q&A. This is our last polling question. Did this webinar meet your expectations? Yes or no? I'm going to give you about 15 seconds left to respond. Please don't forget to press submit to ensure that your answer is recorded. And then we will move on to Q&A. 5 seconds left. And here are our results.
Well, that's wonderful to see. This is Kate again, Kate Kelly with PNC. Hopefully everybody can see those strong results. We're happy to see that. Really great discussion, both from Stuart and Mark. A lot of great information, and we need information in this environment. It's just so rapidly changing. But now we're in the brief Q&A section. We have a couple Q&A questions posed. I'm going to be looking these through and then bringing them to Stu and Mark so they can take a look at it. Let me just glance at this. I'm just going to say the first one right away so I can review the others. There is an expectation that second quarter corporate financial results will be ugly. Has the market adjusted for this potential already? I will throw that out to either one of you, Stu and Mark.
Why don't I'll take a shot at it, and Stu, or Stu, if you want to take it, that's fine. I think you're right. I think okay. I think the expectations are exactly right. Ugly is the word. We're probably talking down 40% or so in terms of year-over-year earnings on the S&P. So that's pretty ugly. I don't know that I've seen anything that bad in quite some time. That said, I kind of want to say it's a little bit in the rearview mirror. We know that the second quarter is going to be pretty bad. The real news as we go into the third quarter, into July and into August, will be what is guidance looking for the back half of 2020 and 2021, and that guidance will help determine where the market starts to trade in the back half of this year.
Great, thank you.
Yeah, I was just pretty much going to say the same thing on the economy. I mean, we look at GDP numbers, they only come out quarterly, but clearly the market is looking at, weekly, even daily data, the unemployment claims data, data on mobility, all kinds of new data has come out, or it's been there, but focused on Apple mobility, credit card usage. So what the market's looking at, what economists are looking at, is as bad as April was, the data, particularly housing data, mortgage applications in May and so far into June, are saying that part of the economy's decline is in the rearview mirror from the market's point of view. And I think they'll be focusing on some pretty good monthly data that have come out and will continue to come out over the next couple of months, and obviously think about the earnings implications for that, as Mark talked about in the guidance.
That's great. Hey, we have several good questions, so I'll just kind of take them in order of priority, or in order of when they were submitted here. One is, this question says, all the discussion of the U.S. being smarter about having production of essential items like pharma, et cetera, being in the U.S. and not China. Does this feel like a real movement that will benefit the U.S. economy going forward?
I'll take a shot at that. I think it does. I think we've learned a lot in this pandemic about maybe who really are essential workers and how we pay them, and about production chain, the supply chains. So I would not be surprised whoever wins the election in the next several years, certain health items, healthcare items, and other types of what are considered essential, maybe food products, will all be viewed at as, even if they require some subsidy from the federal or state and local governments, to say we need a manufacturing and a distribution presence here in the U.S. And I think that sense of dependence or independence, if you prefer to look at it that way, that we used to have on certain defense items and certain types of items, are now going to carry over to healthcare items and maybe other types of things that relate to that. And even if it's, quote, not the most economical, that you could produce it more cheaply someplace else, getting it here, distributing it, and having some direct control over the production of it, I think is something that is going to make a big difference in that, and probably does benefit the U.S. economy to have that produced within our borders.
That's terrific. Stu, this next one is addressed to you specifically, wondering if you have any update on global trade.
We haven't really seen much update on global trade. We'll get some data out. Global trade collapsed, not surprisingly, during this period of time, both because of the pandemic concerns and also the supply chain disruptions. I think what we will see as production increases and cargoes continue to move around the world, we should see an increase in global trade. Maybe not in global tourism or global, leisure travel, but in terms of movements of goods, and obviously some financial and insurance and other types of entertainment services, I think along with the improving global economy will an improvement in trade. Now, for the U.S., since we run a much larger deficit, notwithstanding what I just talked about in the healthcare, it probably means that our imports are going to go up as consumer spending goes up. Our exports will also go up as well. One thing certainly affecting all of this is a heavily traded item is oil. And we've seen, obviously, dramatic declines and now more recent positive or gains in oil prices. So some of that will certainly affect some of the trade data, but I suspect that the movement of oil around the world, and maybe natural gas, but particularly oil, is going to play into those trade data. So maybe ex-oil, ex-petroleum, I do think we will see an improvement in both the dollar volume and the actual real volume of tradable goods. And of course, one more caveat that keeps coming to mind is aircraft. The U.S. was one of the world's largest aircraft exporters, depending on what Boeing does with the MAX and other planes. And given how slow we do expect, international or even domestic airfare travel, that's probably going to be a drag on trade going forward.
Great. Well, we have about 3-4 more questions and about 3 minutes left on our call, so we'll do kind of a lightning rod into this. So I'll throw this out to either one of you. The next question is, what are your thoughts on the U.S. housing and mortgage markets?
Quick response is they look quite positive. The mortgage applications indices, since the collapse in March and April, have come roaring back. In fact, they're above and this is to purchase a home, come back higher than they were a year ago. So these record low mortgage rates, which are now down 30-year mortgages in the 3 to 3.125% arena, lower than any of us have seen in our lifetimes. Despite all the problems in the economy and the unemployment, maybe we spend enough time at home that people are thinking about what home they want to be living in, and the mortgage conditions are very, very attractive.
Yeah, they are. They're amazing. Mark, your good, bad, and the ugly slide probably prompted this one. What are the capital markets participants expecting if Biden wins and if Trump wins? Which political result is embedded in the forward equity prices? That's a good one.
That's a really good one. And I would, pardon me, I would say at the moment, the equity market's not really focused on the election, because I think the election is going to cause a lot more turbulence in market thinking in the next 3 months or so. I think it's given Biden's platform, if Biden wins and the Senate stays Republican, much of the platform, and assuming the House stays Democratic, much of the platform, we might only be able to do a few modest things around the edges in terms of tax policy and the like. Regulatory policy, obviously, you'd have a lot more leeway. But in terms of tax policy, the idea of getting a corporate tax increase with the Senate held by Republicans is very unlikely. If, however, the polling numbers start looking towards a Democratic sweep, where it would be Biden as the president and both the Senate and the House are Democratic, then more of the Biden platform may come to the fore. That would include reversing about half of the corporate tax decrease that we had, as well as some changes on personal tax rates. You'd see tax rates going up. You'd also see spending going up, particularly in areas of infrastructure. So, the market hasn't started focusing on that too much yet. And if Trump wins, I think it's, the market is and has the same mix in terms of Republican Senate and Democratic House. I think the market would be more sanguine in that environment.
Terrific. And I think this has to be our last question. Any of the questions that we did not answer, I will ask Stu and Mark to maybe get an email off to all of you. But this question was partially addressed, but let's see what your final answer is. Can the U.S. job market sustain its recent gains?
Yeah, I think it can, but it has a long way to go. I mean, gain in May of 2.5 million, maybe the largest monthly increase, but let's remember that in the 2 previous months of March and April, it fell by about almost 24 million. So, we got back, 1 out of 10 jobs? I think it could sustain that. Maybe, there'll be some months stronger, weaker. I've been looking at June. I think payroll jobs will be up 3 to 4 million in June. And as I said, we think we can see further gains through the second half of the year. So I'd say yes, but until you could put that many people back to work, or until you could get the unemployment rate anywhere near the 3.5% it was before the pandemic, I think that's several years away at best.
And that's helpful, Stu. Thank you. And this is the only question we didn't cover. Let's see if you have a short answer for this as we wrap up. What is the expectation among capital market participants regarding bankruptcies expected in the next 12 months? I don't know if there's a quick answer.
That's a tough one. I would say, back in March, we would have been expecting a lot more bankruptcies simply because of the turbulence in the bond market and the fixed income financing parts of the capital markets. Given all the Federal Reserve policy, we certainly would see, markets have settled down tremendously. So bankruptcies we would expect would be lower than had we expected back in March. That said, particularly in smaller business, I think we're going to be challenged. And in mid and larger businesses, the rate's going to go up, but not nearly as bad poorly as it would have been had there been no actions by the Fed and the Congress.
Well, we're wrapping up here at the end of the hour. I want to say thank you to FEI Twin Cities, really great program we put on, and to my colleagues, Bo Stewart and Mark, thank you so much for great information, and to all of you for being on the call. Thank you very much. If you have further questions, you're going to get instructions from FEI Twin Cities on my email, and feel free to send it to me, and I will tap both Stewart and Mark for their help in answering your questions. Thank you, everybody. Take care.
This marks the end of our webinar. Thank you for joining us today. We look forward to you joining us on future webinars. You can find information about upcoming webinars in the resources widget. Don't forget to download your CPE certificate in the certification widget. Your CPE certificate will also be available to download in the thank you for attending email that will be sent in the next 24 hours. If you have any questions regarding CPE credits, please feel free to email conf@financialexecutives.org. Have a wonderful day, and again, thank you to our speakers for today's webinar.